for joining us. My name is Rafia Hasan. I'm Chief Investment Officer for Wipfli Financial. Before we get started, I wanted to cover a few quick housekeeping items for our webinar today. So all participants are going to be muted. You'll still have access to the chat box, which can be found in the menu bar of your Zoom window. You should press more if you don't see the menu bar. We welcome you to submit questions through the chat box. We do have several questions that were submitted in advance that we're going to start out with. And any questions that we can't get to today will be addressed directly by an advisor after today's event. So as we approach the end of 2021, global stocks have delivered very strong returns and the economic recovery has continued with some small bumps along the way. And while we seem to have averted a prolonged economic downturn, the pandemic recession has been recorded as one of the shortest in history, just lasting 2 months. There's still many concerns about what lies ahead for the economy and markets. So to shed some light on what's going on with some of those questions that linger out there, we wanted to bring you the perspective of a thought leader in the investment industry. And our guest speaker for today is Brad Long, who recently stepped into the role of Deputy Chief Investment Officer at Fiducient Advisors. Fiducient is an investment consulting firm that advises on over 225 billion of assets across family office clients, institutions, and high net worth clients. In his role at Fiducient, Brad oversees the firm's research teams, including responsibility specifically for the global equity, global fixed income, private market assets, and global real assets teams. So welcome, Brad, and thanks so much for being with us today.
Thanks so much, Rafia. Glad to be here.
All right, so we're going to start out with one of the biggest topics on people's minds this year, and it's been the subject of many questions that were submitted for today's webinar, and that topic is inflation. The Fed recently conceded that inflation seems to be persisting for longer than they originally anticipated, and also saying we may continue to see elevated inflation levels going into 2022. So, Brad, let's start out with where do you see inflation going over the next 1 to 3 years?
Yeah, I think the big thing that the Fed's grappling with, and frankly all investors are grappling with, is inflation and the narrative around it has largely been on the demand side. So it's the proverbial doors swing open as we exit shelter in place from COVID. Investors and individuals, consumers are out there buying goods. So if you have more people buying the same amount of goods, prices rise. And so the narrative has been this is transitory. You can only come out of COVID once. It's going to move on. Where I think the market is beginning to take hold, and your comments on the Fed are exactly right, is the issues around inflation are more multifaceted. It's not simply just people buying more goods. They could be COVID related, but in some instances they aren't. And what we're actually seeing the persistency come around is more on the supply side. So the price of an individual item, I think it's easy to understand. More people want it, so the price goes up. Sometimes, even if you have the same amount of people that want the same good, but you have half of those goods, the price also goes up. We're fighting inflation on two fronts, and that's where the Fed and other investors and market participants like us, are looking and saying, what is the persistency of that? And so on the supply side, there are some things that are directly COVID related. It could be a factory shuts down because people have COVID, and you have to wait a period of time before you can start back up. But it's more nuanced than that, and there's a lot of headlines around this, but you see it in things like shipping ports. I know the LA port has been a topic of conversation, but it's fuel shortages, natural gas, fertilizers, silicon, right? Computer chips. It's showing up in a lot of different ways. And so, when we think about the persistency of that, there's greater likelihood that it's not simply just a demand side effect that inflation has risen, but that there could be more of the supply side, which keeps inflation lingering on. Now, it doesn't necessarily mean that it's runaway inflation or material inflation or going to cause any kind of market correction, but we should be and thoughtfully aware that inflation is more likely to be persistent and not the simple narrative of just we've exited COVID, people are out buying goods.
Right. And I mean, I think one of the, we talked about the 1 to 3 year kind of inflation expectations, but then if you look kind of longer term at 5 year and what what markets are anticipating on the 5-year, it's still in that 2.5% to 3%, whether you're looking at the 5-year break-even inflation rate, which is closer to 3%, or the 5-year forward inflation swap, which is more in that 2.4% range. So even when we're talking about those elevated inflation levels, I think another important point to underscore is also, the levels that we're talking about, that it's higher than what we've seen preceding the pandemic, but it's certainly not something that is that is that hyperinflation that many people fear from the 70s and so on. So I think that's another important point to recognize, as well as we see all those headlines, right, about the inflation numbers. So kind of taking that back to portfolios, how might inflation impact the long-term performance of investor portfolios, and what changes, if any, should investors be considering for their portfolios? Repositioning the mix of equities to fixed income, anything that you would comment on there?
So I think your point on the magnitude of inflation is important, right? If inflation is runaway inflation, that has a far more adverse impact on the price of assets. Inflation in that, let's just say that the 5-year break even is a perfect predictor of 5-year inflation. It's at 3%. That's materially higher than what it was before, but it's still, very modest. The most direct impact that we talk about is just kind of volatility around fixed income. And the logic proceeds there is that as inflation rises, interest rates may rise. As interest rates rise, that has an adverse on bond prices. Now, there's a short-term effect there and a long-term effect there, and it's going to vary based on the type of fixed income you own. So treasury inflation protected securities, those securities that are fixed income but contractually linked to CPI or inflation, they can fare better than just regular bonds that trade in the market. But bonds aren't just a single grouping, right? I think if you think of higher inflation, lower bond prices, that's a little too short of a narrative. So portfolios that have obviously active fixed income can take advantage of this. I know portfolios that many on the line own, like PIMCO Total Return, Dodge and Cox Income, et cetera. They're very well aware of the potential for rising interest rates. And then also things like non-investment grade fixed income or municipal bonds, right? They react slightly differently. So there is, a direct potential impact on fixed income. But then as you look kind of broadly, equities, for example, equities are a great long-term hedge against inflation. They usually out-earn inflation over longer periods of time. Now, in the short term, it's noisy, right? Because inflation could be up today and stocks are down today. But in the long term, they are a great inflation hedge, just given their opportunity to out-earn and outpace inflation. And there are parts of equity portfolios that have just in regular indices that have exposure to inflation-related assets like real estate, materials, commodities, energy. So those are already built into indices and can respond to it. So equities, by and large, are a good source of inflation-hedged long-term returns. But I think the key there is long-term, right? Because in the short term, there can be noise in that.
All right. And so let's shift gears a little bit. And you talked about inflation and then the potential impact on fixed income as a result of that and on interest rates. So, the Fed has indicated that they're going to start tapering bond purchases maybe as early as in the next few weeks. And there seems to be also increased thought that maybe the Fed might begin raising rates by the middle of 2022, as early as that. So what are your thoughts on interest rates over that near term kind of time frame, and any comments you have to share there?
Yeah, maybe borrowing from our magnitude discussion, right, of inflation. So yes, the Fed, they certainly gave themselves more headroom on their ability to keep rates low and stay accommodative, even if inflation is rising. They did that by doing average inflation targeting, and that was a shift in policy, really in Jackson Hole in 2020. So they've given themselves more space, but they're kind of at the point where they're saying, either the market is moving ahead of us or we may need to be responsibly moving towards easing some of the accommodative standards. But on magnitude, so the Fed right now is buying $120 billion a month in purchases. That's a month, not a year. So we're already talking about a very accommodative stance. The initial conversations were reducing that by 15 billion. So it's a big number outright, but it still remains a very accommodative stance. So it's moving in the right direction, but it's not necessarily just pulling the whole punch bowl from the party, and markets react. And that's where we haven't seen that type of reaction. If you remember, I think it was like May 22nd of 2013 when Ben Bernanke said, QE is going to slow, and we had the taper tantrum. We have seen rates rise, and that happened mostly in September, but not this upheaval of interest rates and a massive rise. And I think it's the signaling that's been very modest, and also market participants should probably come to expect an eventual easing of a very accommodative stance. These measures should really be used in periods of material stress like COVID, like the great financial crisis. So I think we should expect to be moving in this direction, but it could cause some interim volatility. The only other thing that we would mention, which is outside of fixed income and outside of interest rates, but almost a little bit more on expectations around volatility, is largely since Ben Bernanke introduced quantitative easing, investors have kind of expected a little bit of a bailout when it comes to risk assets. And economists call it moral hazard. I would call it addiction, right? But they're expecting to say, hey, if markets are down, we're going to step in for you. As easing begins, and it's not a question of if, but when and how much, there could be just greater volatility in aggregate. And that's not a bad statement. It doesn't mean the market's going to crash. I think we all know that investing in risk assets means volatility, but there has been this narrowing of volatility as federal and monetary programs have been very accommodative. If those slow or maybe even someday cease to exist, volatility in aggregate could rise. But I think we should just expect that and kind of lean into that as a necessary narrative of where we're going to progress as the Fed starts to ease.
All right, so on that topic of market volatility, we had a number of questions kind of in this same vein. Is, do you anticipate a market crash within the next few years? Markets have been really volatile in 2021. Do you think that the volatility is going to calm down next year? Or are we expecting more volatility? What are your, and I know you've already shared some thoughts around that, but anything else in terms of your crystal ball here, Brad, for predicting when the next crash is coming?
Yeah, no, I left the crystal ball in the closet, my magic eight ball, and trying to figure out market crashes. I do think that there is, if we take a step back and just look at volatility in aggregate, and whether it's from since material volatility in February and March of 2020, or even the GFC, volatility, there's been a lot of headlines, there's been some events, but even most recent volatility, I mean, the S&P has been up 7 months in a row until September. So volatility largely has been like upside volatility,
right,
if you would call it that. Now, the last week of September, the S&P was down 3.3%. I think there was an intraday move there that dropped as much as since May of 2012, so kind of even through COVID. But volatility, I think, it's somewhat of a necessary evil. It's kind of like if you drink too much, you should expect a hangover, right? So as we invest in markets, we should expect volatility. Now, whether or not we're going to have a crash or a correction in the near term, we don't know that, and nor do any prognosticators with any kind of precision. But I think it is reasonable to say that again, as accommodative policy step back, there's less of what they call the Fed put. Basically, daddy, Federal Reserve Chairman bails us out. That seems reasonable for the makings for volatility. But again, that's somewhat of a should be a constant narrative and an expectation that will be part of markets. The only thing, if we start to get a little tea leavesy, if you will, one of the things that market participants did through COVID was we basically said, okay, this is unprecedented, and we don't know what's really going to happen. But as market investors, especially in March of 2020, we're going to look through this. We're going to believe that the sun will rise again and that things will become normal. And so what that means is that investors have purchased assets, but they've said, in the future, we expect you to deliver on this. So that comes through earnings expectations. Now, earnings expectations have been high and prices have moved ahead of that, but largely companies have been delivering. They've been beating on earnings. And if we look at just this quarter alone, I think it's something like 84% of the S&P has beat on earnings expectations this quarter. And so they have been delivering, which is good. Now, there is potential volatility that if we an investor said, well, I trusted you, pick the stock, Apple or Google or S&P 500, but you're going to eventually have to deliver on earnings. If companies start to fail to meet some of those high expectations, you could see additional volatility. Now, again, that's not a prediction for any kind of correction. It just means that there might be more variability and we should be prepared for that. And some of our comments on the supply side of inflation, it's starting to play into some of earnings conversations. So 8 companies thus far in Q3 have actually given negative guidance on earnings. Some of that is just unique to that company. Some of it is, I can't get enough stuff to build the thing that I sell to sell to my consumers. So if we see more of that, which leads to less opportunity to earn our way into full valuations, that could produce greater investor anxiety, which could mean volatility.
Yeah, no, I think that those are great points. And I think the other thing that, we have to understand is today when we're looking at those earnings numbers that are coming out, we're comparing to really low baseline numbers from 2020. And going into 2022, our baseline numbers are now higher, right? And, we have seen actually even as compared to 2019, there's been some growth in terms of earnings. So now we have those higher baseline numbers that we're comparing against. And so going into 2022, I think, it's rational to, and I think that the consensus expectations are also that, some of those great earnings numbers from a growth standpoint are going to come down.
Yeah.
All right. Well, let's switch gears just a little bit and talk about the role of international stocks. Now, international stocks have done well so far this year, if you look at international developed as a whole, but they're still lagging US stocks on a year-to-date basis. And then emerging market stocks have actually been down, they're now slightly negative. It seems like, we've seen international stocks trail US stocks for a couple of years now. And does it still make sense to have exposure to international stock markets?
Yeah, it's a great question. I think a lot of investors are asking that same thing. And to be honest, I don't blame them, right? There's been this really since the GFC, it feels like if I just own the S&P, that's really all I needed. And if you really zoom out, there is a long history of the cyclicality of success for the US versus international or vice versa, and the reasons that they change. But maybe just to take a step back and talk about why would we own anything other than the US? And by the way, we own a lot of US in our portfolios, no question about it. But when we look at international, I think the main thing when we talk about is first at 100,000 foot level, right? We have 350 million people in the US. There's 7.8 billion people globally. That's 4.5% of the total population, right? There's a lot that lives outside of our borders. Then as we go beyond that, it's like the US is 16% of GDP, right? So there's still a lot of things that sit outside of our country that I think are very important. So I think as investors at that 50,000 foot level, we should really think about what's going on and how we want to, potentially invest outside of the United States. So those are kind of key variables. Then as we look at opportunity costs, there's about 4,000 stocks in the US. There's double that globally. I think we need to consider those things as we're investing into those markets and the opportunity that lives outside of it. And then the last thing I'd mention is valuations. I think the forward or the trailing PE on the S&P 500 right now is 25 times, something like that. Internationally, it's at 16, 15. Don't quote me on those, but either way, it's materially more expensive. So we should, valuations is a key consideration for future opportunity of growth and return. And so we need to think about that as we start to not just look in the rear view mirror that the US has outperformed, but in the windshield, right? And where we want to go in the future.
All right. So in that same kind of vein of international stock exposure, I want to talk about China. So, the Chinese stock market has experienced a pretty sharp pullback this year. and the government's really been cracking down on certain sectors. Can you comment on what is going on there, and just emerging markets overall, but China specifically, and what's going on there?
Yeah, it's certainly an area of the markets where there's a lot of opportunity for discussion, a lot of headlines. Our view on, well, let's just take it in aggregate. So China's an important economy. It's the world's second largest economy. If you take China and its kind of counterparts, Taiwan and Hong Kong, it's about 50% of the emerging market index. So it's a little bit like where China goes, at least the EM index goes. Now, that's not representative of all 30 countries that are in EM. EM is not defined by China, but nonetheless, it can definitely sway the index, and it's an important variable. But when we think about a lot of the headlines that have happened recently, to be honest, it's a little bit of just a reminder that China is not a capitalist economy. It's a communist country. And as you look at the CCP, the China Communist Party, led by Xi Jinping, the things that they've been doing are frankly on brand for what really China has been talking about since Mao in the 1970s, and kind of the social contract with its citizens. We will take some social freedoms, and in exchange, we will give you, rising economic benefit through wages or opportunity, et cetera. Now, the last 20 years, they've largely done that through markets, but they still have this overall kind of command and control approach. So give just a couple of examples. Like a headline that came through was what happened with education, in particular, like private tutoring. So some of those companies were forced to go become nonprofit. It seemed like China was just scooping money off the top and putting it in their own pocket. Well, really, if you zoom out of that and you say, what was the objective there? Well, China, much like the US or a lot of other countries, has a wage gap. The rich are getting richer, the poor, well, in China, the poor are getting more wealthy, but not at the same pace. And there's a big difference there. Well, we just know through study that education is a key link to future earnings. If you are educated, then more you're educated, there's a high correlation to future economic wages. So China said a lot of citizens, and it's not just the billionaires, but it's the middle class. They were paying for private tutoring. They were educating their sons and daughters, and that was elongating or growing that wage gap, whereas those that couldn't afford it weren't. So they stepped in and said, unlike the US, right, we're a capitalist-based economy, they stepped in and said, you know what, we want to close this gap. We're going to put more money into, just public education. We're going to turn these for-profit companies into nonprofit companies, and we're going to distribute the ability for tutoring and education in an effort to close that gap. They've been talking about that for a very long time. So similar things with Evergrande and others, right? They are executing in a way that they've executed before. The only thing a little different is, Xi Jinping is, effectively changed their equivalent of the Constitution and is now, kind of become more of an emperor as opposed to a two-term head of the China's Communist Party. So there's a bit of a shift there, but their role in the economy and in markets largely reflects their role as we've understood it. So we don't think it's necessarily a shift, but it does, I guess, awaken investors to say, this is a volatile market. It's important to make sure how I'm structuring my portfolio there, how I'm thoughtfully invested, the potential volatility. But in spite of recent headlines, it feels like it's just people waking up to what we already thought was in place.
Right. And I know we had a question around, how much exposure do our Wipfli financial clients have to China within their portfolios? And I would say, I obviously can't comment to a specific client's exposure, but in general, we've got about 10% of the equity exposure to emerging markets. And, of that, China is probably anywhere from 30 to 40%. So it's a pretty, I would say, reasonable or modest amount of exposure, maybe 3 to 4% in a 100% equity portfolio. And so, understanding certainly the risks there, that's part of the reason why, you certainly want to be diversified and not have, all of your eggs in any one country or basket, and be very, very thoughtful about the exposure there. And it's kind of probably looking at it relative to the world market breakdown of how much exposure do you have to various countries across the global stock markets, and looking at that total market portfolio exposure, and then determining, okay, how much exposure do I want to have to this?
Right.
And you touched on, Brad, a little bit of the Evergrande kind of crisis and potential debt default there. And there was concern for a while that that was going to be a Lehman moment for the markets. And thankfully, that has not transpired. But anything more that you can share with us there in terms of impact to the broader real estate markets as a result of what's going on with Evergrande?
Yeah, I think, again, tying actions back to narrative. So, the social contract with Chinese citizens has, hey, we are going to increase, your economic wages, your economic benefit. Part of that trend has been taking people from like suburban or even rural environments to urban environments. And so many people have moved into cities. You have these like ghost cities, as you kind of see scary headlines. Well, basically, Evergrande and many other Chinese real estate companies have built ahead of that trend. But part of the premise there was, we're going to rely on future rent growth to be able to pay our debt for all of the building that we're doing. The China Communist Party looked and said, wow, rents are getting really expensive. The people, the middle curve of people that we're trying to benefit can't really afford these anymore. We're going to reduce the ability to grow rents. Well, that obviously has an adverse impact on companies that are wagering on future rent growth to pay for debt that they need to build and to continue the real estate boom. So Evergrande was a symptom of that, and obviously it hasn't turned into a Lehman moment. But I would say this is not a new policy. They were just the most recent to fall. So I think it was Anbag, it was another, HNA was another, that were both Chinese real estate companies. Each actually had more debt than Evergrande did. They were able to move through and kind of restructure that debt without it being a systematic risk. It's just, this is the headline that caught on. So I would say, again, it's not a departure from historical narrative. It's still on narrative. It's just understanding the rationale of kind of why, and then making sure that you understand those systematic risks. And part of that, I believe, that the US reaction to that was our recency bias of like, oh my gosh, debt, Lehman, real estate. Like, if you would have changed real estate for, I don't know, popsicles, right? You could have changed it into something else. We probably wouldn't have had the same reaction. But nonetheless, it seems like that has not been a systematic risk, that it's been thoughtfully restructured. And it probably won't be the last. But as they continue to delever there, frankly, that can build a healthier foundation, because we all know massive leverage can equal lots of risk, and they're obviously moving off of that.
Brad, any thoughts around potential contagion, like for banks that held that debt, and so how that might end up impacting those lenders that are also participating in other markets? Is there any concern around that? Because I know that's the real fear is, okay, is this going to spread to other markets?
Right, kind of the Grecian defaults, we're all in it together, EU type conversation and debt. Look, I think as we talked about kind of the moral hazard with investors and the Fed put, like in some instances, if institutions are lending to Evergrande with a very levered balance sheet, there could be, and maybe should be, some default and loss of capital there. Now, a lot of that lending has actually happened within country. And if we know anything about China, China doesn't like its dirty laundry aired anywhere else. So we don't see a lot of this debt showing up in, say, like the portfolios that we own, or in Europe, or the coffers of the federal treasury. Those are not places that it lies. So it doesn't appear, no, we can't guarantee that there is just kind of this domino effect for debt, into either other countries, economies, financial markets, et cetera. But again, that's part of kind of China's control, and they really don't want that dirty laundry aired anywhere. And so I think that's probably been part of their primary prerogative, is to make sure not to do that.
Right, Brad, we actually received another question, and it's kind of related, not related to China, but more around this topic of easy credit. So many companies are advertising monthly payment structures to purchase their goods versus the total cost of purchase. How are we heading back into a credit crisis in the future, and how do you see this affecting our economy in the future?
It's a great question. Capital is cheap, and that's for individuals. Not all individuals, admittedly. It's for individuals and corporations, to take on debt. If you look at the consumer today, and the consumer in the U.S. is about 70% of GDP, roughly, the production of GDP. They have less leverage on their balance sheet today, and they have more savings in their savings accounts than they do today. Now, if you add into that total wealth, which includes assets like equities and stocks and others, there's clearly been a reflation of a lot of those assets, and the value of those assets is much higher today. So if we were to make, Susie Smith into a company, her balance sheet looks strong. Now, companies are not obtuse to that, and they're saying, okay, I want to incentivize you to buy these goods. So, 0% interest for 12 months, or come get this or that. I think that's part of that kind of financial engineering and timing of purchase is always going to be, part of the system. But there's nothing that we see today that says it is a overconsumption, over-levering binge on credit. Now, you can say that there are always going to be pockets of the market that can be ugly, and I think that's just a persistent factor of, if capital is cheap, you can probably misuse it. But in aggregate and on average, you don't see that just kind of across the consumer at large, or even corporations at large. There's been much made about the debt that lives in kind of corporate American balance sheets, and nominal debt is admittedly higher, but the cost of that debt is lower. So the burden of that debt is less. And so there are trade-offs there. So there doesn't seem to be systematic risks that are showing up across the system.
So speaking of kind of that looser monetary policy that we've had in some areas of the market that maybe people are allocating capital towards that we haven't seen as much in the past, I wanted to bring up the topic of the recent launch of the Bitcoin futures ETFs. What are your thoughts on cryptocurrency and Bitcoin futures?
Cryptocurrencies are actually a really interesting topic, especially as we talk about like contagion in China and decentralization, digital assets at large, not just those that are kind of a quasi currency like cryptocurrencies, but also NFTs or other digital assets. It's clearly a burgeoning space, one that cannot be ignored. Now, when you start to break down kind of the fundamentals of those, it becomes a more difficult conversation on this. What's driving price is far more sentiment. So if Rafia and I both are really interested, and you continue to believe that crypto is more, I can sell to you and you sell to me, and that drives price. Now there's purpose and functionality of these assets, but largely there is no economic earnings or like a company or a country that backs some of these. So I think they are of great interest, but I think their economic viability is one that just should come with kind of great skepticism. So for those that are interested, I'd say the first thing is just be wary. Mostly, we started the conversation around volatility. These assets are extremely volatile. And so just sizing and thinking about that in portfolios, I think, is an important allocation decision, in that, if investors are a believer in that space, that it doesn't have to be kind of a home run type, I want a lot of this in my portfolio, but kind of thoughtfully allocating in size there. And then, as we step into like an ETF launch or others, in some ways, I view that as you're widening distribution, yes, which could be helping or hurting investors, depending on your perspective. But you're also bringing kind of some things into the light. So you get SEC regulation, you get you get oversight and context, as opposed to the way to access a lot of cryptocurrencies or NFTs. It's getting better, but historically has been less beneficial to investors. It's more costly to enter and exit, et cetera. So I think the institutionalization of these is in aggregate probably a good thing for those that want to access. But I think the fundamental case for them is still yet to be told.
Yeah, I was listening recently to a podcast about the recent launch, and one of the things that came up was, just being really mindful of the cost of custodying these types of assets, and that it is actually much higher than traditional assets. And so, that's definitely something to be mindful of in this space. And then the other thing with the anytime you're purchasing a futures ETF to be able to access the underlying, you have to be mindful that the returns might not be exactly mirroring or correlated to the underlying asset. And that can be true whether you're looking at commodities and like oil futures, or you're looking at Bitcoin futures. You're not necessarily getting that underlying asset exposure and just in the same way. And so the returns might end up being quite different to what the actual price return of that commodity is.
I think many investors that have invested in, say, like oil ETFs have probably learned the difference between futures and physical in a very forward-facing way. It's a very good point.
Yeah. Okay. Well, I know we only have maybe 7 minutes left. So I'm just going to go through and see what we can kind of get to. We've talked a lot about what's been going on kind of in the next, or what may happen in the next 1 to 3 years. But I know, your firm goes through the process each year of putting together these 10-year capital market expectations. And those are the market expectations that help inform the asset allocation decisions and how much to have in various asset classes. As you start to go through that process, which I'm sure is coming up, can you talk a little bit about what are the things that you are looking at as you're coming up with those capital market expectations? What are the things that you don't pay attention to because you think it's maybe more noise? So can you comment a little bit on that?
Yeah, it's we're like on the precipice, right? We talk about this all the time, but the recalculation of this really happens in earnest starting in November. So we've our capital markets committee, which is led by our chief investment officer. We've been really deep in these conversations. As you noted, we use a 10-year view. Anytime you're trying to predict, right? The shorter the time frame, the harder to do. The longer the time frame, not always, but generally, the more efficacy. So we think 10 years, we think we have a reasonable insight into future opportunity, but it's not the super secular, see it in 50 years type time frame. So it gives us a framework in which to say, on a relative basis, where does our interest growing and where is our interest shrinking? As we look and sit here today, equity markets relative to where we started the year are more expensive in the U.S. than they were when we started the year. Now, part of that actually recently has come down because earnings have responded to that. But it's a richer market here today in the U.S. than it was. Mostly driven by China, right? Because China, I think, is down 16, 17% year to date. But that has really brought down emerging markets in aggregate. So international is looking more attractive. Jerome Powell through the third quarter, with his conversations around potential tapering, I think the 10-year was at an intra-quarter low of 119 and went to 156 by the end of the quarter. So a move in rates, not taper tantrum, but certainly rates moving higher. That could potentially be a little bit of a ballooning and opportunity for fixed income and kind of future return, because the primary predictor of future returns of fixed income is what is my current yield. And then obviously on the muni side, that math still stands, but then the direction of future taxes could either make that more or less attractive based on kind of the cost associated with the friction of paying tax. So as we kind of start to read tea leaves, I think the main things that we're talking about, we've largely hit them already. persistency of inflation and the potential impact and growing concern, both in the short term and the long term, because that is, inflation can be a series of short terms that equals one big long term. Potential market volatility, and not in a nefarious way, but just if we reduce easing, if we have high expectations for earnings, if we have investor sentiment with a lot of headlines, that could create volatility. Again, doesn't necessarily mean a correction, but it does mean how do we think about appropriately sizing investments and asset allocation. And then relative decisions, right? So the US versus international, those type of decisions as we start to frame the end of the year, largely driven by valuation and opportunity, but obviously handicapped by the volatility that they're going to introduce to the portfolio.
So if we were to translate that to, kind of investor portfolios, I mean, when you're making those capital market expectations and looking at asset allocation decisions, are you completely firing certain asset classes and or getting rid of fixed income, or is it more, hey, we might make some minor tweaks, but in general, the portfolio stays still well diversified, and you want to continue to have exposure to some of those major food groups, let's call it, of investment?
No, we definitely still want proteins and vegetables, and so those major food groups are important. And to be honest, it comes down to diversification is an admittance of imperfect information. Like if we knew exactly what was going to happen, we would own just that and nothing else. But we don't. So the less we know, the more we want to diversify. And we know quite a bit, but we obviously don't have a crystal ball. So when we think about the role of fixed income, for example, even if fixed income does not have a very, very high future return, my ability to bear risk as an investor is different from investor to investor, right? So fixed income can play an important role in reducing aggregate volatility, producing current income in the portfolio for retirees, et cetera. So major food group exposure matters. Now, when I'm in the vegetable food group, do I want both apples and bananas? Like maybe or maybe not, right? You can have some of those discussions and modest changes and shifts based on expectations. But to your point, usually you're definitely not firing full food groups. And then even some of the sub ones, we spent a lot of time figuring out, do we want bananas? Do we want apples? Like these play an important role. So it takes a lot to unseat those. Now, just our relative interest might shift over time. So it's modest shifts, effectively leaning into things that we like more, leaning away from things we like less. And then if there's an alarm bell on any one of those, it can be a full reduction or removal of any of those, but taking those thoughtful kind of probabilistic moves to add value over time, and also be cognizant of things like paying taxes, friction costs, trading costs. Those are the reality of which we live in. So even if we had a crystal ball, you would still want to be cognizant of those things.
Right. So I think we've got time for just one last question. And Brad, you touched a little bit on this, which is taxes. There's a lot of proposals right now in Washington, and things are changing really by the day. What we would have talked about on Monday of this week is very different from what we might be talking about today on Thursday. And so any thoughts on, I know you're not a tax expert, but you've got folks at Fiducient who are more focused and watching these things. What's the House view in terms of how likely is it that some of these things get passed? And, quick thoughts on impact to financial markets, if any.
Yeah, I mean, I think your point on changing by the day is an important one, right? We had the Ways and Means Committee, in the House of Representatives, largely, talking about corporate income taxes and some changes here and there. And, I think we had Arizona and, West Virginia Democrats coming together to try to pull those things. And then all of a sudden it's a weekend and it's a billionaire tax. And, it's Elon Musk has a $52 million tax bill, right? Or $1 billion tax bill. So the volatility of, change here, I think, is one of the important things to note. But there are important outcomes. Like at the end of the day, we as individuals, we invest in the markets, and then there is friction, and part of that friction is tax. And so we should be thoughtful of that. I would say a couple of things, maybe just broadly, and then getting in a little bit more in the specifics. One is if you look back over time, increasing corporate tax rates, decreasing corporate tax rates. World War II, we had very high corporate taxes trying to pay and personal taxes paying for the war effort. Then it dropped over a period of time. Under Trump, we reduced corporate taxes. Under Obama, we had higher corporate taxes. The market marches on. It doesn't really have a strong influence on, especially short term, but even longer term outcomes. The thing for us to be most aware, I think, as investors, is that once something is decided, the Ways and Means Committee actually gets its act together and decides on something and tries to pay for a very large infrastructure or whatever bill that's coming through, is to be optimal with it. Okay, with this information now in hand, should we own more municipal bonds? Is this going to have an impact on certain segments of the market? Most of the time, the answer is no, it does not. Because corporate taxes go up, they mostly go up everywhere. So it's not like I like energy more than I like financials. They are both impacted by this. But it's being thoughtful as individuals with financial plans and working with Wipfli and others is, okay, now that I have this information, how do I optimize with it? So I think it's somewhat of a, I don't know, an unsatisfying answer when you can't say this is exactly what it means. But I think most of the time for markets, it doesn't have a material effect on future prices.
Yeah, and I think one of the things that's most important to underscore is that even as tax rates go up, it becomes so much more important to ensure that you have a tax efficient investment program in place, and the tax management that you are able to do becomes that much more valuable. So I think we're just a little bit over time, so we've got to wrap up. That 45 minutes went by super fast. Thank you so much, Brad, for joining us, and thanks everyone who's attending. We hope the conversation was helpful, and we encourage you to reach out to your local advisors with additional questions or assistance to navigate through your financial journey. Have a great day.
Thanks, Rafia.